Hi, everybody. Welcome to our fourth session on retirement. Before starting the session, I wanted to cover exciting new initiative that we are working on. So a couple of administrative things, actually. The first is I hope all of you have gotten a chance to see our video on our new tool for members. It's the sector tool that we've released on the website. It's a really, really great way to see if you're as diversified as you think based on your mutual fund portfolio. So encourage you guys to use it. If you have any questions on how to use it properly, just email us at advisory@bharosaclub.com. The other initiative that we're thinking about developing is something that helps people that do fully passive investing. They invest entirely through an advisor, and we're just in the ideation stages on this tool that we're thinking about developing. But if you know anybody that works extensively with an advisor and would like to be a part of our beta thinking around this, please reach out to us and let us know, because we would love their input as we design this tool to best benefit people like them. So again, just let us know if there are any candidates that you think could use a tool like this that helps them monitor what their advisors are doing on their behalf. So with that, I'm going to get started on today's session on retirement. Um, so quick recap of last time. We discussed what risk means in the context of finance. We discussed how standard deviation helps us think about risk in a mathematical way. We talked about it. A lot of you were a little confused about it. So I'm going to try again in this session to explain it more simply. And then we walked through how to calculate it, and we incorporated it into our Excel analysis. So in this session, we're going to further the ball on risk, and we're going to specifically talk about the power of diversification, why it helps us manage risk, what kind of risk it helps us alleviate, and what kinds of risk it cannot help us alleviate. And we're going to discuss how to diversify properly, including our tips on how to stay diversified across your portfolio. And we're going to introduce our next session, which is going to revolve around case studies, trying to use all the knowledge that we've covered in the first four sessions and apply them to actual hypothetical scenarios where we try to design an investment portfolio for a hypothetical person. So that'll be really useful to see the thought process that goes around how to construct a portfolio that matches your needs. So let's take another shot at standard deviation. So before we get into standard deviation, I want to talk about the need for something like standard deviation. When we're thinking about returns in the future, we're making guesses. We don't know what the return is going to be in the next year. We don't know what the return is going to be in the next 2 years, 3 years, etc. So when we make predictions about the future, one of the questions we like to ask ourselves is how good are our predictions? And what is the likely range of outcomes of how wrong we can be? And the tool we use to answer this question is standard deviation. And the way standard deviation works is we look at the past history of the thing we're trying to predict, and we look at how volatile or how much it bounces up and down in the past. And if it bounces a lot, then we uh, basically measure that level of bounce, and we incorporate it as a uncertainty factor in the future. Think about it this way. If you have something that is very stable, that doesn't bounce around a lot, it's very easy to figure out how that thing is going to behave in the future, because the past is a very good estimate of how it's going to behave in the future. If you have something that bounces up, bounces down, swings wildly, then there's a good chance that you could be wrong in the future, because the behavior is very unpredictable. So standard deviation helps us measure how predictable or unpredictable something is. So the more risk averse you are, you want to look for things that are more predictable, that have lower standard deviation. And the more risk taking you are, you want to look for things that are higher standard deviation, that are less predictable. So good example of this is Bitcoin versus gold. So for any of you that are following the price movements of Bitcoin, you will see that it could be up 15% one day, it could be down 15% the next day. It is extremely volatile. It bounces up and down a lot. So when we're trying to make a guess about where Bitcoin's going to be in 1 year, we have a very, very high standard deviation around our guess. We're not very confident of our guess. When we look at something like gold, there is less bouncing up and down in the price of gold. You could have the odd day where gold is up 3% or down 3%, but you're unlikely to see 15% swings in gold. So when we make a guess about the future value of gold, we have less uncertainty around that value. Same thing with large cap stocks versus small cap stocks. Large cap stocks are more predictable, they behave more cleanly than small cap stocks. So that's kind of what the standard deviation is a measure of. And the higher the standard deviation, the more unpredictable something is. So that in a nutshell is what standard deviation is, why it's useful, and why we care about it. So hopefully that helped clarify the concept. And I'd encourage you to re-watch our last video because we also talk about how to measure it in Excel, etc. So now that you understand the concept, you can actually start measuring it and figuring out what the standard deviation is of the various funds, stocks, etc. that you're investing in. Okay, so now let's move on to the topic for today. We're talking about diversification. So diversification is based on a very simple observation that a lot of us probably know intuitively. It basically means don't put all your eggs in one basket. You may have heard that phrase, or hedge your bets. It basically means you don't want to concentrate too much on one single thing and become overly dependent on that. You want to make sure that you leave some buffer for being wrong. So let's probe a little deeper into how diversification works to lower risk. So when we think about the kind of risks that diversification lowers and the kinds of risk that it cannot lower, what we look at is two kinds of risk. One is called non-systematic risk. So non-systematic risk is a risk that impacts one thing in particular or a handful of things in particular. So for example, the risk that a company shuts down its plant, or the risk that a new regulation is passed that hurts a particular industry. These are risks for particular portions of the economy, not for the economy as a whole, not for the entire system. We have another category of risk called systematic risks, and this is a risk that impacts everything. So you can think of very good examples of this that have occurred recently. So COVID-19 pandemic, it didn't matter if you were selling, selling kirana store goods, or you were producing zippers for clothing, or you were producing oil. Your business was hurt by the COVID-19 pandemic. It was just a question of how much, but COVID-19 impacted everything. So we call this a systematic risk. Same thing with the 2008 recession. It was a global slowdown, so it impacted everything in varying degrees. So in these kind of risks, everything goes down together. It's just a question of how much. Some things may go down more, some things may go down less, but they impact everything at once. Since diversification works by spreading your bets across different types of investments, if you have a systematic risk, since everything anyway goes down, diversification cannot protect you that much from these kind of risks. What it can protect you a lot from is non-systematic risks, because those are risks that are just confined to a very small portion of the economy. So if you're well diversified, even if that little piece of your portfolio goes down, the rest of your portfolio will be fine. So that's why systematic risks cannot be protected by diversification, and non-systematic risks can be protected by diversification. So the good news is the risks that we really care about for a investor with a long-term time horizon are really these non-systematic risks. and we can diversify them out in a well-balanced and well-constructed portfolio. Because most of these systematic risks do not end up affecting us over long time horizons. So as long as you've got a long time horizon, diversification can be a very, very good tool to help you manage your portfolio. Okay, so I'm going to talk about another mathematical concept called correlations. And correlations are basically a mathematical concept that help you see how closely two things behave together. Do they tend to go up together and down together, or do they tend to behave independently? They don't really move together one way or the other. So a good example of this is, let's think about the following example. Which one gives me more diversification? If I have Hindustan Unilever stock and I add Britannia to my portfolio, or I add Reliance. Well, you probably intuitively can see that HUL and Britannia are both FMCG companies. They're both exposed to the same industry risk. They're both serving the same customer segment in the fashion of consumer staples demand. And therefore, they tend to behave very similarly. On the other hand, HUL and Reliance are very different companies. So when we think about where you're going to get more diversification, it's going to be from adding Reliance into your portfolio, not Britannia, because you want to find companies that do not behave too similarly. Because if they all behave too similarly and that sector of the economy gets hit, then your entire portfolio will get hit. So in finance speak, we say that Hindustan Unilever and Britannia are highly correlated, which basically means if one goes bad, then the other one will probably go bad. And RIL and Hindustan Unilever are less correlated, which means they aren't as intertwined. Just because one goes down doesn't mean the other is going to go down. So the lower the correlation between two investments, the greater benefit we get from diversification. And we can actually measure correlations. And I'm going to show you guys in Excel how you can do that. And I'm going to upload them to the website, and you can see exactly how to calculate these for any two funds, stocks that you have data on that you want to see how correlated are they or how uncorrelated they are. So let's talk about the maths of diversification. Can we actually estimate how much of a benefit we're going to get from diversification in terms of lowering our risk by looking at the standard deviation of the portfolio before and after we diversify? And so the key inputs that we're going to use are the standard deviation of each security and the correlation of the securities together. So let's see how we would do something like this. So I'm going to bring up the Excel screen. Hopefully you can all see the Excel screen. Anita, just let me know if it's not coming on the screen. But the first step is we want to measure correlations. Okay, so let's say we're interested in three stocks: Britannia, Hindustan Unilever, and Reliance. So what I've done here on this tab is I've put historical data. So this is around roughly 3 years of data.
Sahil, can you increase the zoom on the screen? I mean, yes, like on the Excel.
Yeah. Is that better? Is that better?
Yeah, that is better now.
Okay, that's better. Great. Okay, so what we're doing here is I've pasted 3 years of data on Britannia, Hindustan Unilever, and Reliance. This is the daily stock price of each of these shares in this column. Then in this column, F through H, I've calculated the daily return for each of the stocks, okay, which is just, the price over the day prior price minus 1. And then I'm calculating the correlations of the stocks. So we're going to have 3 separate correlations: one for Britannia against Hindustan Unilever, one for Hindustan Unilever against Reliance, and one for Britannia against Reliance. So we can see how these stocks behave relative to each other. So interesting data, as you would expect, as we discussed in the prior slides. You can see the numbers here. A correlation of 100% means the stocks move identically. So 100 means a perfect correlation. And the closer to 0, the more independent and random the variables or the two stock price moves are. And you can also have negative correlation. So that means if something goes up, then the other one goes down, right? They tend to move in opposite directions. So zero means they behave completely independently. There's very little relationship. Correlation of 100 means they move perfectly in tandem. And a correlation somewhere in between means that they're somewhat related, but not perfectly related. And the higher the number is, the more related they are. So you can see that Britannia to HUL, as we expected, has a 60% correlation, 58.46% correlation. And I use the formula Correl in Excel to do this. Again, the Excels will be uploaded so you can see exactly how I did it. Now, if you look at Hindustan Unilever to Reliance, you can see it's only a 35% correlation, and Britannia to Reliance is around a 39% correlation. So you can see that our suspicion that Reliance would diversify the portfolio more because it's a more different company is actually correct, right? They tend to behave more differently than Hindustan Unilever and Britannia. This is why Reliance would diversify the portfolio more. The next thing I did is I also calculated the standard deviations. I'm not going to spend a lot of time on this because we covered it in the last class. But the standard deviations are calculated here on a daily and on an annual basis. So this annual number tells us how much risk there is to a future guess on where the return of Britannia, Hindustan Unilever, and Reliance would be. And this is also interesting data. It's showing that Reliance is a riskier stock than Hindustan Unilever and Britannia when you look at the standard deviation numbers. You can see that the standard deviation of Reliance is 35%. It's only 25% for Hindustan Unilever and it's 28% for Britannia. And this kind of makes sense. When you think about Britannia and Hindustan Unilever as businesses, maybe their sales will go up 6%, 5%, 4%, 3%. There's very little movement on the sales that Britannia and Hindustan Unilever report because people are always going to need to buy sabun. They're always going to need to buy biscuits. They're always going to need to buy all these things. They may trade down to cheaper biscuits, etc., but they're always going to buy these things. But when you look at Reliance, it's got a much higher standard deviation. Why? Because they're very sensitive to the price of energy, and the price of energy swings a lot. So their revenues can move up and down a lot. So this is showing us the power of standard deviation. It's showing us that mathematically we can actually measure an estimate of how much riskier Reliance is than Hindustan Unilever and Britannia in terms of volatility. So now let's try and incorporate some of this into some math about how our portfolio would behave under different scenarios. So let's say that I have a portfolio that consists entirely of Britannia, and that's it. It's 100% of my portfolio. So I have my return. I'll increase the zoom again. So hopefully people can see, it's clear. So here I have the return expectations of the various components of my portfolio, the standard deviation, which we calculated on the other sheet. So for Britannia, it's 28.4%. For Reliance, it's 35%. And the percentage of my portfolio that it comprises. Now, this return expectation is a complete guess. Let's say that I think Britannia, my best guess for where Britannia is going to finish is 12% higher in the next year. So I just populate this with 12%, right? And my best guess for Reliance is maybe there's more upside for Reliance. I'm going to guess maybe 15%. Now I know the standard deviations from our calculations on the other tab. And currently my portfolio is 100% Britannia. I also know the correlation of Britannia to Reliance, right? We got that from here, this 39.04%, 0.05%. So I filled that in as well. And now I can get some statistics on my portfolio. So since it consists entirely of Britannia right now, the return I'm going to get under my base case is 12%. And that return has a standard deviation of 28.42%. That's how likely my guess is to be wrong, right? How much risk on volatility there's going to be on my return estimate. Now, let's say that I wanted to see how my portfolio is going to behave if I reduce my share of Britannia and I add some reliance for diversification, right? So now I'm going to make Britannia only 50% of my portfolio. Okay. So something very interesting has happened. So my expected return has actually gone up. It's gone from 12% to 13.5%. Why is that? Because I'm expecting a higher return on Reliance than I was on Britannia. But the other very interesting thing that happened is even though Reliance has a higher standard deviation than Britannia, my standard deviation also went down. Why is that? It's because Britannia and Reliance are not very correlated. There's only a 39% correlation. If, on the other hand, I had made this 100%, they behave completely identically. They go up and down together. Then see the standard deviation climbs to 31.72%, right? So this correlation is very important as we think about managing risk, because I've done something very good in my portfolio right now. I have added a stock and I've increased my expected return and I've reduced my standard deviation. So I've lowered my risk in terms of volatility at least, and I've increased my expected return. This is a really, really good outcome. So this can show you how diversification can really, really help you manage your portfolio. Um, and decide what kind of stocks you want to add and what kind of stocks you don't want to add. So again, I'll upload these Excels so you can walk through the math, you can follow the formulas. This formula down here is a little complicated, you can see. Um, but just it's basically measures the blended standard deviation of two different securities in a portfolio. If you want a detailed discussion of this, you can take it up with me offline on advisory@barosaclub.com. Uh, Great. So now let's move back to the presentation. So, so this is great. We've seen the power of diversification. You can get higher returns and lower risk if you diversify properly, right? But it can be very tricky to be properly diversified. Let's take an example. Is this bond portfolio properly diversified? Let's say I have a 5-year sovereign gold bond that's 25% of my portfolio. I have a 10-year GSEC that's 25% of my portfolio, and a 10-year duration AAA credit fund that's 50% of my portfolio. If this all sounds like Greek to you, don't worry. Uh, Essentially, we'll get to the punchline. You just trust me on this nomenclature and just go with it. But basically, this looks pretty diversified, right? We have gold exposure, we have government exposure, and we have corporate exposure. So three different types of exposure, diverse set of end markets. So if the government, for some reason, the bonds don't do well, and but the corporate does well and gold does well, my portfolio will be fine. If the corporate sector runs into trouble and gold does well, then I'll still be fine. So I am hedged from an end market, and my end markets are nicely diversified. But is there something hidden that's common to all of these investments? And the answer is yes. These are all long dated instruments. One is 5 years, the other is 10 years, and the other one's also 10 years. And so when we think about what's common in this portfolio, it's a multi-year bet on interest rates. And if interest rates don't behave the way we're thinking, then this portfolio could be in trouble. So when we're trying to diversify our portfolio, one question you should always ask yourself is, are there any hidden commonalities under all these investments, across all of these investments, that if it were to go wrong are going to impact my entire portfolio, right? So how would we properly diversify a portfolio like this? Well, we'd put some money in shorter duration things, ultra short term, overnight funds, etc. And then you'd have a nicely diversified portfolio. Okay, so is there a drawback of diversification? So while proper diversification lowers risk, The more we diversify, the more our return potential tends to get diluted. So why is this? So the more we diversify, the more our bets offset each other. So let's say that I invest in only one sector. I only invest in pharma. And let's say pharma does really well. I'm going to make lots of money because all my investments are concentrated in pharma. My entire portfolio is going to do very well. But then let's take a scenario where I invest in pharma, I invest in technology, I invest in finance. I'm going to have exposure to different sectors. So if pharma does very well, but banking doesn't do well, then my portfolio is not going to go up as much as if I were entirely in pharma. So because the bets tend to offset each other, this leads us to a very powerful concept that most people don't follow. The degree to which you should be diversified in your portfolio directly depends on how confident you are in your bets. If you're someone that has done a lot of research, stays current on the news, has a good understanding of which industries are going to do well, which industries are not going to do well, there's a case to be made that you shouldn't be overly diversified because you have a lot of confidence in your view of the world. If you are somebody that doesn't have a view, that's totally fine, but you should be very diversified. You should perhaps look at index funds and passive funds, etc. Because you may be very wrong if you were to get overly diversified in one direction. Okay, so let's get to some tips for properly diversifying your portfolio. The first is assess your confidence level on your investments to determine how much diversification you need for your portfolio. Take an honest assessment of how knowledgeable you are on your investments. If you're not very knowledgeable, you should err towards being more diversified than less. Specifically for equity, avoid individual stocks unless you've done your homework. And when I mean homework, look at our series on stocks zero to hero for an example of the kind of work you do. Individual stock investing can be very risky. I'll give you an example. In our small case, we were invested in a company called UPL. We had done lots of homework on UPL, had a thesis on it, and basically, if anyone's followed the share price of UPL, you can see it's a roller coaster. And your homework is what's going to help you ride that roller coaster well. If you've not done your homework, it's very hard to stomach the ups and downs of these kind of shares. Use our sector tool to monitor the exposure that you're taking in your funds. So you may have a portfolio of 10 mutual funds. How do you know how diversified they are? Well, we have a tool that basically combines all those funds and tells you how exposed are you to technology, how exposed are you to pharma, how exposed are you to auto, how exposed are you to FMCG. So you can see, are you taking too much of a bet on any one sector or not? And if you're totally overwhelmed, it's perfectly fine to just stick to index investing. One of our most popular tools for members is the Wealth Simple tool, which just enables you to invest passively in indexes. And the most amazing thing is our best performing portfolios are the Wealth Simple portfolios, because in general, the average is a very, very good result. Most people that try active investing miss the averages. So it's not even a bad decision from a return concept to stick to simple investing. For debt, most people remember to diversify across credit quality. So they won't put all their money in a single A fund. They'll make sure some of it's in triple A, some of it's in double A. But many people forget interest rate risk. Right now, interest rates are very low. If interest rates were to climb, the longer duration your debt investments are, the more their value will be hit. So if you're sitting in 10-year treasury government securities and interest rates move, the value of those treasuries will come down much more than if you're sitting on 3-year government securities. So duration is a key risk to diversify across also. Many people forget that. Other tips: gold and foreign equity exposure can be very good diversifiers because they have lower correlations to Indian securities. So gold in particular has a very low correlation to stocks. And foreign equity, because it's not exposed to India, and different trends in different countries also has lower correlations than Indian equities do to themselves. So these are very good ways for you to diversify. Okay, so we covered a lot. So where to next? Well, we've done a hell of a lot in the first four sessions here. I'm going to try to now move to a case study where we try and take our learnings to work through a portfolio for a hypothetical person. How would we actually construct a portfolio for someone that's recently retired using these principles to make good, safe portfolio construction decisions? And then after that, we're going to move ahead with more material. We're going to cover specific topics. How do you analyze common retirement products like annuities, reverse mortgages, etc.? How do you deal with large one-off costs that you may face, like healthcare costs, etc., that are unique to retirement? How do you plan your expenses, budgeting, etc.? So we'll be moving to those discussions after the case studies. And then we'll do more case studies after we cover those. So that's kind of the plan for this series. So with that, I'll open it up for Q&A and then we'll conclude.
One question so far. Let me just get to the question. Generally, staying with your winners is a very good bet. Is that correct? What price you bought does not matter.
So this is a very general question, and it will depend on the situation. Basically, you should always think of holding a stock like buying the stock at its current price. If you are deciding not to sell a stock or a fund, you're basically deciding to reinvest that money in that fund at today's prices. If you believe that the price of that fund or stock is fair or cheap, then it's a wise decision to keep holding your winners. If, on the other hand, you believe something has overcorrected to the top, to the upside, right, then you should look at trimming your exposure to that stock. In general, a stock that has become more expensive needs a reason to have become more expensive to warrant you being as optimistic on the share price going forward, because it's a higher price for the same asset. But if the price has moved up for a good reason, then it very well may be the case that it's still undervalued and still a good deal for you to be in that stock. I think a lot of people make the mistake of knee-jerk selling their winners. That's not a good idea, but it is very useful to have a healthy dose of skepticism on your winners, because it's also very easy to drink the Kool-Aid and say, you know, what a genius I am. I picked this stock and it's done so well and it's just going to keep going up. And, you know, so a healthy dose of skepticism is good. And just, you know, stay intellectually honest, do your analysis and see what you think, if the current price is still a good price.
Okay, I think there's no other question. So we could wind it out here.
Okay, great. Thanks everyone for joining. We will, as always, be uploading this into on the website, the website, and look forward to seeing you guys in 2 weeks for our case studies. Thanks.